Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next 25 minutes on Options Guide TV. Today is Friday, April 5th, 2024. We had jobs numbers come out today, and they were a little bit hot, which points us to a lot of data that's coming out next week. In particular, CPI is coming out on Wednesday. So everybody's drawing their attention to that number now, considering that, I guess, once again, that good news is bad news. A nice medium number would have been around 200,000 or so, but I think it came in at 303,000 new jobs that came out this week. If we had the good number would have been right down around 200,000. Below that would have been a bad. So I guess we have levels now where we want to see those jobs being settling in at, as far as the economy is concerned. But it's just an odd marketplace where usually if you have good jobs numbers and good wage growth, it's a good thing for the market. And obviously where the big concern now goes to where the CPI print is going to be at. And we did see the marketplace react to it. As far as the CME FedWatch tool is concerned, we actually saw the big month, which is going to be June. We saw that the probability of a rate cut actually was lowered a little bit. We went from about a 58% chance of a rate cut down to about a 50% chance. So the market definitely reacted as far as the futures market is concerned. And I think the same is going to be the case next week on Wednesday with the CPI numbers. And then you got a bunch of other PPs and cores that are coming out that will definitely drive the market next week. So volatility has increased over this week, and it has a lot to do with, first of all, the seasonality. April usually has a tendency to be a little bit of a tougher month after a real good May, which we had. And then all this data coming out and people still being very nervous about where inflation is at. So on Wednesday's show, we talked a little bit about putting on an iron condor today. I don't necessarily want to do that. The iron condor is a neutral strategy, and I don't want to be in that situation on a short-term basis. Like we always look at speculative trade when we're talking about the weekly trades that we do. A lot of times they're speculative trades. This on Wednesday was a little bit neutral in the marketplace. So we did an S&P 500 index butterfly, and it turned out just fine. We had the market run up and then run back down, and now it's drifting upwards. And I'm going to look at an adjustment to that trade today because I can. And I was actually really surprised when I looked at it getting ready for the show where the market is at relative to a smaller move to the upside. So I'm going to concentrate on that adjustment today. And I've gone through it before, but I think it's really good when you have a scenario where it kind of makes sense. And every minute that ticks and that goes away, it's going to make less and less sense in general. So let me go through what that adjustment is today. Then we're going to leave this week without a paper trade on. And we'll probably look at a more directional trade next week. Either we'll look at a short call spread or an alternative to that, which to me is a skip strike butterfly, or we want to get long the marketplace. So maybe we'll look at a long call spread. So that's going to be on the agenda for Monday. We still got a little bit more cleanup to do in the deep in the money paper trade portfolio that we have. Today's show is just going to be about the adjustment and all about the very short-term trade that we put on Wednesday. So I'm going to start by going to the options playbook. So here's the homepage of the options playbook. There's going to be a lot of changes that are going to be happening to the book. Also looking at adding some content to it. But the strategy tab that I want to focus on is the long butterfly, long butterfly with calls, which we put on Wednesday. The market was right around strike B. It was an at the money, not a directional butterfly, anticipating that the market was basically going to go nowhere for a couple of days. And that wasn't the case, in that it was volatile. It's ending up fairly close to where it started, but it was very volatile in the move. There were a couple of big moves. Something happened at 2 o'clock yesterday, and people were debating exactly what was going on. But we had Fed comments, we had comments, geopolitical comments, and the market reacted strongly to whatever those comments were at 2 o'clock yesterday. But so buy a call at strike A, that's below the market. Sell 2 calls at strike B, that was at the money, basically where the market was at, and then buy a call at strike C. We did this in the S&P 500 index. Now, the market did this, okay? The market went here all the way up above strike C. So you're like, that kind of stinks a little bit. Then came all the way down, hung around at strike B, and then went all the way down below strike A. So we said 1 day's worth of time decay would make this trade profitable. And that was true. Anytime on Thursday, if the market comes down around strike B, you'd be looking to get out of the trade at a profit. It might not be a doubler, or you might only be making, and I say only with air quotes, because maybe you're only up about 20 to 30% on the trade. But if you get the luck of 1 day goes by and you end up at that short strike at strike B, you want to take advantage of that. And actually, let me zoom in on this a little bit. There we go. That looks a little bit better. And then you want to take advantage of that. So now you should have been out of the trade. You should have been out of the trade on Tuesday when we came back within that strike, and we talked about that on Wednesday's show. Now, what we're going to do is we're going to adjust this trade. So let me build this butterfly graph for you. And I'm going to start out with the bull call spread, and I'm going to zoom in on this one too. All right. So here's the bull call spread. We're buying strike A and selling strike B. All right. So if we jump back to the butterfly, that's buying strike A, selling strike B. Here's the second spread that is involved in the gaggle of options on a long butterfly with calls, is a short spread. So in this instance, we are, let's go one less. We are selling strike A and buying strike B. So we run back to the butterfly. You got strike B that you're selling. That'd be an additional one, and strike A. So if you take this trade and you got this little finger sticking out on the long call spread, you do the short call spread, they cancel each other out, and you end up with the butterfly. Now, I say that, and the reason why I introduced the butterfly this way is, first of all, it's made up of 2 spreads. So we're going to roll back into a short call spread, and we're going to do this live. Hopefully the market hasn't moved too much, because it was a possibility when I first looked at getting set up for the show based off of where the prices were at. So let's go back now, and we're going to jump out a little bit. Let's run to the TradeHawk software. And I have set up here right now. Okay, yeah, we're still at about the same spot. Based off of the screen graph that we had on Wednesday's show, the screen grab that I took, we did a butterfly. We did a 25-point wide butterfly, which means that we had a 50-point range that was a good range for the marketplace. But we had to pay a little bit. We paid because we did it on Wednesday. Normally, we maybe be a Monday trade or something that would last for the week. But we did it on Wednesday, which means there wasn't as much time premium in the option contracts on the at-the-money options as there would have been on Monday. So the butterfly was a little bit expensive. And we put this entire trade on for $4.30. That was the midpoint. If you could have got that midpoint fill, it was the April 5th expiration, which is now 0 days remaining. So in here we're showing that we are in the April 5th expiration. And if you scroll down, let me grab this here just for a second. And I do see we have a question. I'll address it here in just a minute or two. So we buy the 5200, sell two of the 5225s, and buy one of the 5250s. That was done for $4.50. Now at this point in time, the market is at 51.91. So we're pushing it here. And we actually have this trading at a profit to us. So we did have the market come back, and it's came back strong. This option contract, when I first looked at it at about approximately 45 minutes ago, this was trading for about $5. Now it's trading for about $9. So I'm still going to go through the adjustment, but you could obviously just get out of this trade if you're up $1 almost on this trade at 5.30 at this point in time, and you might want to just stay in it. If I had multiple positions on, we always usually look at a 1-unit trade, a 1x2x1 butterfly. If we had 3 of these on, or maybe 4, I would think about selling half of the position at this point in time and thinking about letting the rest of it run. All right. Now I have a question before I get into the adjustment. It's from Wayne. Let's toss it up here. Hey, Brian, 2 questions today. How many weeks before earnings do you usually start to see options volatility increase on a stock? All right. So that question, the I'd say 7 days. The last 7 days is when you really see the implied volatility start to creep up. And I think of it as when I'm setting up time spreads. If I set up a time spread based off of earnings, I'm going to be buying the expiration that would contain the earnings. In other words, the earnings would be announced before those options expire. And then I'll usually go about 2 weeks out and sell an option contract that does not have the earnings in it. So I want at least a 2-week period in between, not just 1 week. 1 week isn't enough. I want to be about 2 weeks. So in that last week is when you really start to see the spike. And obviously the last 2 days are very important, just like in the S&P 500 index. And the next, Wayne's got a follow-up question. And if I'm bullish and buy a call, how do I hedge the position? Do I sell some actual Apple shares? Do I sell some actual? If I'm bullish Apple and I buy a call, how do I delta hedge the position? Do I sell some actual Apple shares? So that, Wayne, that would imply that you have Apple shares, right? I don't think you're thinking that you're going to go short Apple. I don't want to go short Apple going into earnings, but that would be the ideal. I guess if you're a market maker down on the trading floor and you're long Delta, a way to get short Delta would be to sell shares of Apple, and that would you could get Delta neutral on that position by doing that. Or you can go on out and sell different option contracts. Now, when I look at earnings, around earnings, and we've done this a lot on the show, is if you straddle the marketplace, you're fairly Delta neutral on that position. And that if you buy an in the money option contract, and let's say we go 5 points in the money and we sell an out of the money option contract, we're really just creating a situation where we're just focused on the movement of the underlying stock, but I'm selling some negative delta and I'm buying some positive delta in that instance. If you want to make the position zero delta, or delta neutral, or you're trying to scalp gamma the way that a market maker would, you can sell the share short, and you'd sell the same amount of shares that was equal to the delta on that position. But that's a much higher discussion overall. So the question would be to me, Wayne, by your comment, are you talking about selling Apple short? And if you're selling Apple short, yes, that's one way that you could become delta neutral on that position. Now, let's get back to the adjustment. So the adjustment has everything to do with the the combination of the long call spread and the short call spread. So if you choose not to get out, and so now we're back to a point where we're actually losing some money. We're down about 30 cents on the trade, and it would make much more conducive to actually roll this position as opposed to just closing it out and getting out of it. But we seeing this option contract trade for $6. So quite simply, we're going to add a lot of requirement to this trade because when we put the trade on, the maximum loss was what we paid for it, which was $4.30 or $430 for every butterfly that we put on. So for every unit, every 1x2x1 butterfly. Now, if we do this, this roll would be expensive. And so I'm going to show you two different alternatives on the roll, depending on the amount of margin that you would have in the account. We went 25 points wide because we wanted to have a wider area where the market could land in. And there's still a possibility it could get up. We're at 36. We're now at 51.38. So the 20 points, we were close to getting up to the 5,200 level, which if we landed somewhere above 5,200, obviously that would be good for the trade. So here's the adjustment. I guess I should probably clarify that. I say that because the potential to just ride it out right now is okay. There's nothing wrong with that. You got half a day to trade. So time decay is going to start happening fast. And it's going to be really hard to adjust the trade after the noon hour in New York, the noon Eastern time hour, because time decay is going to go away and we need some premium on this option contract, this one that we're selling. So we're selling the most expensive option contract, which is trading for $5.70. And then we'd be buying the cheapest contract, which is the 5250 contract, and we're rolling into two short spreads by doing that. Once again, we're playing off the fact that a long butterfly is made up of a long call spread and a short call spread. So in this instance, if I'm doing this roll, I'm going to just adjust this trade down below. We are going to sell this. We're going to bring in $6. This trade goes away. So this becomes a sell to close, which it won't allow me to do. I'm going to hit sell to open. And then this becomes a buy to open. And by doing that, we are selling an expensive option contract and we are buying the cheap contract. We are still hedged on that position, but we are going to end up being short two of the 2025s and long two of the 5250s. So we're not naked on that position. Now, at this time, we can get this done for a net credit of $5.65 to the account. So this would be worth doing. You got to ask yourself, though, right now, a one standard deviation move from where the market is at 51.80 is here. I'm looking at the delta. The delta is about 16 here, is 52.15. So not a high there's only a 16% chance based on, well, it says 18 right now, but about a 16% chance that based off of a one standard deviation move that the market will finish above 52.15. We are short two of the 52.25s. Looking at the delta, there's about a 10% chance of the market finishing above those levels. Now, as expiration approaches, the theoretical numbers aren't quite as accurate as if you have a little bit more time. Models work better with a little bit of time premium in them, but it still gives you a good feeling that the market cannot get up to this level by this expiration date. Because if it does, you're just going to close it out. If it got up to 52.25, I'm just going to close out that trade. Just that simple. I don't want this thing to get into money and work against me. So if I do this, now I can get it done for a net credit of $6.30. I didn't mind where it was before, $5, but you paid $4.30 for it. And let's call it $5 because we're really moving in the market right now. Let's call it $5. Okay. And I'll put it that way. If we did it for $4.30, we're going to add a lot of risk on this trade. We're going to have 25 points 2 times. That's 50 points of margin that could go against us. And if we did that, that means we're going to have a $5,000 margin requirement. So our account has to be able to handle that. And if you're looking at a 10 lot or a 5 lot, that's going to be fairly hard to absorb. But if you do that trade right now, you would be profitable by 30 cents on the trade if the market stayed below our short strike, which would be 52.25. So the resulting position here, if we did this trade, is, so let's send this to the what if. Okay. No, let's not send that. We'll do this. Okay. So our position would end up being short 2 of the 52.25s and long 2 of the 52.50s. And that would be our short spread. So we bring in a net credit to our account. We add additional risk, high probability of success trade, but anything can happen. You have a half a day left in the marketplace. This is, I don't want the cheese anymore. Let me out of the trap. But it's an expensive trap, right? That we are building here. In that if we do this trade, we really increase our margin. Okay. So that's the adjustment. And there's a cheaper way to do this as far as cash is concerned. And wow, this is just the pricing is working out really well on this trade. Normally, I'm looking to do the adjustment if I'm going to do it on a Thursday where I have a little bit more time premium. But where the market is at right now makes for a really good show. And that's part of the reason why we're going to keep doing this with the live markets going on. This is why this is going to be the focus of today's show. So let's go back and let's set up the initial trade. All right. So now let's go back and say that we are long this one. We are still short 2 of the 52.25s, and we're going to buy 1 of the 52.50s. All right. So instead of selling this option contract and buying the cheapest one, which would add 2 short spreads, we can actually bring in less of a credit. And okay, it's 425. So yeah, this might work out. This actually might be profitable with where the market is at. Here's the alternative roll to the position or adjustment to the position that will have a lesser margin requirement. Okay, so if we focus down here, on the first adjustment, we sold the 5200, bought a 5250, making a 2x2 short spread. Now let's go in and eliminate one of these. So the 5200, we're still going to sell the most expensive one. And then we're going to come in and we're going to buy 1 of the 5250s. All right. And if we do that, this would just be 1. And then we get rid of this leg. If we buy 1 of those back, we can still get this done. Yeah, it works out pretty well right now. This would be probably, if I were to adjust the trade right this second, this would be the way that I would adjust it. You're still going to have the same amount of, or you're still going to have that line in the sand at 52.25. But if I paid $4.30 for the butterfly to start with on Wednesday, and I see this trading for $5.60, we still got the market at 51.90. Yeah, very close to 51.90. 1 standard deviation move is still below this strike and it's only for a half a day, staying at 10% probability of it finishing 1 cent in the money or above this. And by doing this trade, $5.60, so it's $5.90, we'll call it $5.60, jumping around a lot. And we paid $4.30 for it, so that's $1.30. So we'd be a net credit of $1.30. And we would have 25 points of risk. And our risk would be, once again, this one's going to go away. and we would end up with short one of these and long one of these. And that's what our position would be in the account after the adjustment. And that's very interesting the way the market worked out based off of our trade that we put on Wednesday. This is a great example of option pricing. This is how you roll from a butterfly into two short spreads, or roll from a butterfly into one short spread. And I you could do any of these trades, let alone you could just let it ride, and the trade looks like it's pushing profitability. So at this point in time, even if, and you should have been out on Thursday. I'm going to emphasize that when the market came back down and hit that short strike after running up, there was no reason to stick around after that and keep that risk on. But with that mentioned, here we go. This is where our trade is at, and yeah, now we're back to even on the trade again, just based off of the market movement. And there's still a chance it'd be over a 1% move on the day, but if we can get above the 5,200 level, well then we would be all right. Now I see a few more questions coming in. JV's in here. JV, what we got going on? Let's see the question. Hey Brian, I did an adjustment yesterday, late afternoon, by selling the 5,200 call and buying back on the 52.25. So I'm just short one spread. Oh, all right. So you did the second adjustment. Yeah, there you go. And I see the next comment is bingo. Yep. That is a solid adjustment. I like that adjustment. So now though, we're a little nervous because the market has came back a little bit. What was the net credit? Can we know what type of net credit that you received on it, JV? I'd be very curious. Or do you have just ballpark? That's fine. Because you probably did it. I'm sure you did it for more than $4.30 to adjust it. I do not recall. Around five. Okay. All right. So you have some risk now. You have 25 points of risk, $2,500. And if you did it around five, you're looking to try to make about 70 cents on this trade. And once again, I don't want the cheese anymore. Just let me out of the trap. And that's basically what the outlook is for that trade. All right. So we're running up a little bit on time, but I have this in here. Let's send this to the what if calculator, and I'll just try to, if sometimes when I get in here, I stall out a little bit, but let me see if we can zoom in on this and pull this up, and we'll go through what JV is talking about. With JV, the way that we looked at the trade is we would uh this this is the trade, and I'll just go through the first one, right? So in this instance, we on the very first adjustment, we would sell this call and we would add one of these. We sell that call. The 5250s. Those. Okay, there we are. So we're going to add one of those and we're going to sell this. Okay, so we get rid of this. And there it goes. Okay, good. And then we add this 5250, add an option. Well, it's not going as smoothly as I would like it to. The expiration, got to make sure that you got the W's in here. And this is this expiration. And then we're going to go to the 2550s. Aha. All right. There it goes. All right. So this is what you end up with. I don't know if that was worth doing, but so now we have 2 of the 52.25s, and we are short, or well, we're short 2 of the 52.25s, and we're long 2 of the 52.50s. There's 1 and 1. And then if you look at it, here's your short spread. Here's where the market is at, and our risk would come in right there. All right. I don't know if that was a solid ending to the presentation, but a lot about pricing. The market's really worked out to make this a very good learning experience. Now, if I did this butterfly on a Monday and I was looking to make that adjustment, Wednesday and Thursday are really good days to try to make that adjustment. Wednesday in particular, you usually get a lot of time premium that's still left in that option contract. And then we go to Thursday. Thursday gets a little bit more sketch, but we're seeing here that if the marketplace, now this is a little bit more nerve-wracking, but if the marketplace does start coming back in within range of that butterfly, starting to go that way, it's still feasible to make the adjustment, even though we're still out of the money. And it's all about the price of this option contract. So we're now at 51.94 right here. As long as this is trading for more than what you paid for the butterfly, the potential adjustment is there, right? Because this is everything. We're buying, selling the expensive to buy one of the cheaper option contracts. That's it for this episode of Options Playbook Radio. I'll check for any other questions. I don't think we have any other. But with that, so no more questions Monday. On Monday's show, we got a big data week. All attention is going to be on CPI on Wednesday. We'll come up with a strategy based around that news on Monday's Options Guide TV. And if we have to make an adjustment during the week, we will definitely come back and do that. So thanks for coming. If you're on the YouTube channel, please click subscribe, ring the bell so you get all of the reminders for the next Options Guide TV. And we'll see you Monday at 11 a.m. Eastern Time. Thanks for coming, everyone.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.